In our practice, we're always looking at actively tax loss harvesting throughout the year. And let me explain this concept. It can be a little complicated, but once you get it, it's a no-brainer. Tax loss harvesting is really only relevant for your non-retirement account assets. So the ones that you get 1099s, think an individual account, think a joint account or TOD account. So an individual, not a retirement account. So to give an example here is if you had a portfolio with $100,000 in it and you had a $20,000 gain, meaning your holdings had gone up. So you'd end up with 120,000. Obviously 100 plus 20 is 120, but we get our good friend, our favorite uncle in DC sends us a 1099. Now we have to pay capital gains on that. And so by the time we pay the capital gains on the 20K, now the value after tax is going to be 112.6. Where if you're actively tax loss harvesting throughout the year, you can start at 100, you're going to still have your 20,000 gain, but I'm going to take other asset classes that had losses throughout the year at various points. Not every asset class always moves up. There are going to be a few that are going to be losers. You're going to have your winners and you're going to have your losers, but we're going to sell the losers throughout the year so that we can offset using that loss to offset the gain. So you still have the same performance, but now we have a tax asset. And now we don't have a tax liability because the losses offset the gains. And so we've saved $7,400 through the active tax loss harvesting. This does not work in mutual funds. This only works in individual stocks, individual bonds. And I know with our portfolio managers, we're doing this throughout the year because, like I said, there are going to be specific times where certain asset classes are going to do better than others. Mercedes, you were using Tesla. I think it was
Mhm.
2022. Like Tesla was down 90% like December of 2022, and then it was up 98% in January. So the trick is you sell the asset class or the position, you don't leave the market. You want to put like an ETF or an index fund to track that until you buy it back. You can't immediately buy it back. That's called a wash sale, but I believe it's like 30 days or something like that. And literally the next day you can buy that position back. Right? You're not messing with the performance and the allocation. You're just harvesting losses. And you want a professional. Again, I have 3 CFAs that oversee the accounts to be able to take advantage of this. And to be clear again, it's got to be on non-retirement accounts that this is even relevant. Anything else you wanted to add on this, Mercedes?
Well, I think a lot of times, specifically in the last few years, we've gotten to a point where tax loss harvesting isn't always an option. So that's where we then need to look at it from other strategies that we could employ. So maybe your portfolio, we've done all the harvesting we can, and that's where your tax professional, your financial person, and your team of investment advisors should be working together to make sure, okay, if option A is not available, what's our next step? What can we do? How do we need to look at it?
Mhm. And the reverse is true. Sometimes we're harvesting gains. When we have
Mhm.
clients in low tax brackets and we're trying to move the portfolio, we're trying to de-risk it, we might want to make those sales because the capital gains rate for some people might be zero because
Sure.
they're retired. And so it goes both ways on this. And that's what I just want to bring to everybody's attention is managing for taxes is a whole nother layer of skill set with the advisors that you're working with.